Dear viewers, markets saw their lifetime highs of 62,000 on the Sensex almost a year back. We saw it in October of 2021. For close to 1 year, at the time of recording this video, Sensex is stuck well below the 62,000 mark, creating a fear the Sensex may not move up for a long period of time. What might happen if the Sensex gets stuck well below 62,000 for a long period of time? In this episode, I am going to analyze this issue and see what is the effect that will happen to your portfolios, or what benefits or what problems it might create for you. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Markets made a top of 62,000 on the Sensex in the month of October 2021. And from there onwards, markets, it was one-way downward journey. Markets saw a bottoming out at about 52,000 on the Sensex in the month of June 2022. It's close to a year now. We are in the month of August, and another 2 months and the Sensex is below 62,000, which means to say in the last 1 year, Sensex has not done anything. Why did Sensex correct in the first place? The correction happened because the Sensex valuation, or the price of the stock markets, was way higher than where it should really belong to, which means to say it had a stretched valuation. The valuation of the Sensex was in excess of 25 times on the PE scale. It was somewhere between PE of 25 to 30 when the markets corrected from 62,000. That's the precise reason for the markets to correct. We can give any other reasons, but the real reason is the stretched valuation of the market is the reason for the markets to correct. While it is true that we are stuck well below 62,000, somewhere between 52 and 59,000 on the Sensex, what does it take for the markets to move up and conquer 62,000 and move higher? 3 ingredients are required, or at least 2 out of the 3 ingredients are required if the markets have to conquer the previous highs. What are the 3 ingredients? The 3 ingredients are liquidity, or the infusion of cash or supply of cash or generation of cash in the system; a sentiment, that means a favorable inclination of the investor community to come pour money into the stock market; and a supporting growth, that means economy is growing. These are the 3 ingredients which will propel a stock market to conquer newer heights or to move higher from time to time. Out of these 3, at least 2 are required for the markets to move up. Now coming to the growth in India is very good. There is no problem with growth. There are recessionary fears in the United States and in the rest of the world because of the inflation that the Eurozone as well as the US is facing. US has an inflation of around 9%, and against that the bank rates are less than 2% as we speak. UK and other places also have an inflation which is higher than the 5% mark. Now because of this, the central banks are likely to increase the interest rates. They have already started, and this will be an ongoing process, and it can run for many months or maybe 1.5 years at least. That means the rise in interest rate, the inflation numbers are working as a hurdle for the market to move up, and this is affecting the sentiments. So sentiments are not favorable to the market. The geopolitical tensions, what we saw between Russia and Ukraine, and the resultant oil price increase is also creating a hurdle which will again bring down the inflation. Likewise, the problem of COVID-19 in China and disruption of supplies is also a hurdle for the market, and that is also affecting the sentiments. So the sentiments are not favorable for the markets to move up from here onwards. The second ingredient of liquidity. Where does the liquidity come from? Liquidity can come from 2 sources. One, infusion of money from the central banks, that means loose monetary policies, easy money, lower interest rate. That's a thing of the past. Now the United States is increasing its interest rates. it has announced that it is withdrawing the liquidity. The same situation in rest of the part of the world. So the liquidity infusion from the central banks is not happening. The other place from where the liquidity can come is the growth and the feeling of richness or the affluence because of the economic growth. Whenever the economic growth is happening, the inflation should remain low. Then only the wealth effect will be felt in the population. But right now, growth is there, and along with the growth, there is inflation. That means inflation is negating the effects of favorable growth. And this is also not fueling liquidity into the stock market. So the liquidity is benign. Liquidity is being withdrawn, sentiments are affected. Out of the three, two parameters are not favorable for the markets to move up. But growth in countries like India is very good. It is something which is unbelievably good at this point of time. So one ingredient is favorable, two other ingredients are not favorable for the markets to move up, creating a situation that market may get stuck here for a long period of time. This long period of time, how much it is the time? I wish I knew the answer. I don't know the answer. My guesstimate is it will make you wait for a longer period of time. Don't get carried away by what you see in the stock markets now. Periodical rallies, this could be a bear time rally, this could be a counter-cyclical rally, but it is not a robust bull market rally. That we can tell for sure. So it doesn't have the required support to conquer the previous height as per the data points what we visualize right now. So chances are that the Sensex will get stuck well below 62,000 for a prolonged period of maybe few quarters, maybe couple of years. That can never be ruled out. Why I explain why market may get stuck here for a prolonged period of time due to lack of liquidity and lack of sentiments. Let's look at the other metrics of the market. See, we corrected from 62,000 on the Sensex in the month of October 2021. The reason was excessive valuation. That means the price quoted by the Sensex was way higher than its true intrinsic value or the mean values the Sensex has quoted over longer periods of time. It has stretched itself too far away and there was a reversion to mean which was happening. Now, this is the observation we made in the month of October 2021. And it's almost close to 1 year, just 2 more months remaining. What happened in the economy during this particular phase? Because Sensex has corrected, it doesn't mean that the companies are not growing. The Sensex corrected because of the value metric, but what's happening with the companies? The banks are improving, the oil companies are improving, the general economic indicators are showing all kinds of improvement. If you go even by a general number, India is growing at a rate of approximately 7% real growth rate. The India's GDP is 7%. When you say 7% real GDP, on ground, what I and you feel is the nominal GDP. What's the difference between a nominal GDP and the real GDP? A nominal GDP is real GDP, add to that the inflation component, that gives you a nominal GDP growth rate. Now, if the real GDP rate is 7% today, it is well documented. Likewise, the inflation in India today stands at around 7%. So the nominal GDP growth rate is 7% real, 7% inflation, 14% is the growth that has happened in 1 year. So if we had 62,000, it was looking expensive 1 year before, but 1 year later, the valuation of market has improved by 14%. Let me make you understand this with the help of an example now. Now the example that I'm going to give you here is an approximation. Don't take it very seriously because these are not the accurate numbers. The attempt here is made for you to understand the concept, what happens. Now we saw 62,000 on the Sensex in October 2021. Let's assume that the market was very expensive at that time and the price to earnings ratio was quoting 30. That means if 1 rupee was the earning, the market was quoting 30 rupees as the price, which gives a figure of the Sensex earnings for all companies put together at about 2,000 rupees per year. So P ratio was 30, Sensex was quoting 62, so this gives an earning of 2,000 rupees. Now subsequently, markets corrected to 52,000. Earlier it was 62,000, now it corrected to 52,000. Just because the Sensex corrected to 52,000, now divide 52,000 by the Sensex earnings of 2,000, it gives you a figure of a P ratio of 26. That means earnings have remained same, valuation has come down for the Sensex. The expensive nature of the market, which was quoting P of 30, has dropped now to 26, assuming that markets came down to 52,000 immediately. Now let's look at what happens 1 year later. 1 year later, let's say in the year 2022, we see Sensex again at 52,000. What happens to the valuation? In 1 year, as I said, the companies have grown. So there is a real GDP of 7%, inflation of 7%, gives a nominal growth figures of 14%. That means to say, even if I take an average value, Sensex earnings has moved up by 14% from the figure what we calculated 2,000 in the last year. That gives a figure of 2,280 as the Sensex earnings for this year. Now for this year, if the Sensex earnings is 2,280 and if the Sensex gets stuck at 52,000, the P ratio of the Sensex falls down to approximately 22.80. That means market has not moved up, economy is moving, companies' earnings are increasing. That means there is a valuation compression which is happening. That means market is becoming cheaper. Now let us look at the case example of 1 more year. Now 2021 we saw the peak, 22 it is still stuck here, and the Sensex gets stuck at 52,000 for 1 more year till October 2023. But again from now to 1 year the companies are growing. So going by the nominal GDP figure of 7% real plus 7% inflation, which gives me a 14% growth trajectory, for next year October, Sensex earnings will be 2,600. And if the Sensex gets stuck at 52,000, what happens to the P ratio? It will drop further to a level of 20 from the time it was quoting 30, which was in the October 2021. So if market does not move from here, the valuation becomes more compelling. It becomes cheaper and cheaper for the market to be bought, and markets will keep observing on that. I call this as a spring action. So the market is developing a spring action. So when you compress a spring, it develops energy and it has a tendency to bounce back faster. So if market is not moving up, valuation is pushing it up from the top. The valuation metrics, the PE is getting compressed and it is giving a spring action for you. So the market is not moving. Why market is not moving? Because of the two other ingredients what I am talking about. Because of the sentiments and because of the liquidity. A time will come, the sentiments and the liquidity will turn favorable. That means the government would have, or the central banks would have become successful in taming the inflation, and they feel this is the time, let's create a little bit more space for the monetary policy, let's create a little bit of a loose monetary policy, let's reduce the interest rate, let's favor the growth. And that is the point where the markets will go a massive up move. That massive up move that will come will not be 5%, 10%. The massive up move that will come may push up the market by 20, 30, 40, 60%, depending on what is the outlook look like at that point of time. So the market getting stuck here is not a bad news as such. It is a good news for the investors. So this stagnation market, what you are seeing right now, how will it affect the investors? I told it's a good news for the investors. Let's look at how does it affect investors. Will it affect in a positive way? Will it affect investors in a negative way? Honestly speaking, this is a God-sent opportunity for the investors. It gives you ample time and it helps you to buy these assets when the valuations are lower. You should not be worried about the sentiments of others. Observe it from a valuation metric and see you are buying when the valuation is coming down. When do you make money? You make money when you are able to buy an asset for a lower valuation, and when the asset prices increase, that is the time you make money. So it is said, when the blood is on the street, that's the best time to buy the assets. Today, I won't say it is a blood on the street, but the sentiments are affected, because of which the assets are quoting a lower valuation, and as times pass by, because of this stagnation phase, the valuation of the market is improving. A point will come within a short span of 2 to 5 years, a spectacular bull run will start all over again for two reasons. Growth is visible, growth is there, and the spring action the market creates because of cheaper valuation it creates over a longer period of time. So this long wait for you is something which is desirable, always waited for, and to make most out of it. All that you have to do is make best use of this time and buy the asset whichever you want to. Dear viewers, I am a finance professional. I am in the business of helping families build their family's finances. I am in the business of helping people invest wisely, invest in a rational way, invest without bringing your emotions into play, and help you reach life goals. If you want to make best use of our services, be it for any of the life goals of retirement corpus building, wealth building, emergency fund, insurance, pensions, or any segment, you can make best use of our services. Our team of financial guides are always ready to help you. If you are interested, all that it takes is sending us a WhatsApp message on the number that is shown here on the screen, and our financial guide will help you build a robust financial plan to reach your life goal. Why delay? The time is now. Send us a message now. Dear viewers, hope the video that I have done helped you to understand what's happening in the market and how it is working in favor of you. If it helped you to understand these things, please like this video. If you are a person who is watching the videos for the first time, or if you are yet to subscribe for my channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another topic in yet another video very soon.
Press the bell icon for more details and subscribe our channel.